Going to have a look now at questions 11 and 12 from the 2023 paper 1. So the first one is a little 3-mark written question. It says a bookkeeper received a purchase invoice that has not been recorded in the accounts. Explain why this error might not be discovered. Okay, now remember, for 3 marks, we're trying to kind of build a chain of reasoning. So we need to say the type of error, perhaps. So I would be saying this is an error of omission, so something that's been completely missed out. The reason it wouldn't be discovered necessarily is that the trial balance would still agree. So because something's been completely omitted, there would be no difference on the trial balance. Also, if it's a purchase invoice, the purchase ledger control account would still agree with the total of individual balances. So if something hasn't been entered at ground level, at entry level, so it hasn't been put into the book of prime entry, so the purchases journal has been missed out all the way through, it won't mess up the purchase ledger control account. So trade payables would still be the same as the total of the individual amounts. Okay, so question 12, Peter, if we just have a little look at what we're required to do before we start reading the information. This is asking us to prepare an extract from the income statement for the year ended 31st of January 2023. Now, you can fully expect somewhere in the paper to have income statement and or statement of financial position, very basic skills, and you really do need to make sure that you know your layout. So we're doing just the trading section of the income statement. So this will be our sales minus any sales returns, and then cost of sales to come down as far as gross profit. And it's asking us to show the gross profit. And this is just worth 7 marks. So pretty straightforward. And in section A, generally it's pretty straightforward in that you don't get given any information you don't need. So everything that's there, you should incorporate in your answer. Okay, so we've got opening and closing inventory, and very easy to establish which one. 2022 obviously comes before 2023, so that's the opening inventory, that's the closing inventory. We've got purchases, we've got returns inwards. Now let's just think about those. Those are returns inwards, they're coming back from our customers, so those are sales returns that need to be deducted from the sales revenue. Okay. Now, we can't ignore this additional information. It tells us that during the year ended 31st of January, Peter took goods with a selling price, of 2,800 for his own use. Now, remember that when we charge sole traders for the goods for own use, we don't charge them the full selling price, we just charge them at cost. And the entry is to reduce purchases, so take it out of cost of sales, deduct it from purchases, and include it in drawings. Okay, so these have not been recorded in the books of account, and it tells us that the markup on these goods was 25%. Now, if we just remember how markup works, you've got the selling price minus the cost equals gross profit. Now, markup, we're starting with the cost, that's 100%. We're adding the markup, which is the gross profit, which means that the total of those two is going to bring us back to our selling price. Now, this is a useful little calculation for incomplete records and for paper 2 as well. So if we slot in the selling price of 2,800, it's not a case of just multiplying that by 25%. What we've got to do is divide it by 125 and then times it by 100 to find the cost price. So we're stripping out that markup there. So that means that the cost of those goods is 2240. So we need to deduct that goods for own use. 2240 needs to come off in cost of sales. We mustn't forget to do that. Okay, so that's one adjustment. We don't have to worry about the drawings because we're not doing the statement of financial position. Additional information number 2, included in the inventory at the 31st of January were 2,000 items with damaged packaging. These items cost £13.50 each, and they have a selling price of £14.65. The total cost of replacing the packaging is £2,850. Now, this is where we have to compare the cost of those goods with something called NRV, which stands for net realisable value, which is the selling price minus any repairs or any costs that we have to incur in order to get those goods into a saleable condition. So the cost is 2,000 items at £13.50. We're looking for the lower of these two figures. So 2,000 times £13.50 is £27,000. And we're comparing that with the net realisable value, which is what we can sell them for, which is 2,000 times £14.65, which is 29,300, but we've got to pay to get them repackaged. Repackaging costs is 2850. So our net realisable value, what we're going to be left with after we've paid out for that, is 26,450. So at the moment, it's included at cost in this closing inventory figure, and it should be included at net realisable value. So the difference between these two means that we've got a reduction in value of £550. So we're going to need to take that off of the closing inventory. Okay, so when we do the extract from the income statement, let's just put these figures over here. Okay, remember we need two columns. We've already got the title in, don't bother rewriting it again, but you want your sales revenue in at the top. So the sales revenue was this £225,000. We didn't do anything to that. We didn't make any adjustments. Minus the returns inwards, sales returns. Make sure we get that the right way. 16,440. That's going to give us our net sales figure, which is 208,560. Then we can start on cost of sales. I always like to just label it up at the top. We're going to start with the opening inventory. Now you should be writing this out in full. I'm just doing it for speed. No adjustment to the opening inventory. 34,195 in there. Purchases. Now we can either show this as two separate lines. I'll do that probably for clarity. So £155,000 minus goods for own use. So remember, we're crediting the cost of sales here, reducing purchases, and we'll be debiting drawings with that one. We would then need to add in any carriage inwards. We haven't got any carriage inwards there. Take off any returns outwards, anything that's going back to our suppliers. Well, we haven't got any of that. And then the last deduction we can make is for closing inventory. And it's always good practice just to show your working so that when the examiner's looking at this, they can see where on earth you've got the figure from. So we started with a figure of 29,785 and we're taking off 550. We've already got our workings down here for that 550. 29,785 minus 550. And this is a deduction. So we're crediting the cost of sales and we'll be debiting statement of financial position. We'll be showing that inventory as a current asset. So let's just add this up. Find our cost of sales, 2240, 29235, which is 157,720. And then we take that away from the net sales revenue at the top there. And then make sure you label this up, gross profit, otherwise you will not get the mark. Need to make sure that it is labelled. They've asked us to show gross profit, so the least we can do is give it a label. Okay, so that's how you do question 12.